Good evening, everyone. Thank you very much all for coming to our debate on remuneration. I'm very pleased to welcome Tom Huertas, who's the Banking Director of the FSA, David Benson, who's Vice President for Risk and Regulatory Affairs from Remura, and Martin van der Weyer, who's the Business Editor of Spectator, who will be our panelists this evening. Remuneration in the financial sector tends to be quite an emotive issue. It's one of those things that's going to run and run and run. But the more we can actually talk about the issue sensibly, in my view, the better. Because we have an industry that has provided a lot to the UK and has been a significant component of our economy. And whilst obviously there have been failings and things that have gone wrong, it's really important we try and move positively forward and present a good way that the financial service sector can contribute and can be a key component of what the UK is about, without seeking just to get rid of it. Now this evening I've asked our panellists to focus on two particular questions. The first being about whether or not pay in the financial sector at the level it is at is unacceptable. Whether it's being driven by kind of a collective culture of excess, whether it's being driven by other sort of problems within the sector, for example, weak corporate governance or a lack of competition within certain parts, or whether or not it's just the fair reward for talent and success. And maybe the second other question I'd like to address is around the structure of remuneration. Whether or not those things that have been really good about remuneration in the financial services sector, i.e. a very flexible and variable structure, which a lot of other industries would probably like to, perhaps particularly in the public sector, you have a situation where you would like very much to allow businesses to be able to pay when they have money in their pockets, and when they don't, they are able to restrict that. But at the same time rewarding people for working hard when they do things properly. Whether or not you think that's happened is a different matter. But certainly that's something which we've looked at positively. And I think I'd like the panelists to address whether or not the current structure of both for managers and for employees has been such that we've managed to align the incentives for both those employees and managers and all of the stakeholders, whether it's the shareholders, bondholders, even employees, and at end the government, if they are the one who's ultimately responsible for some of the debts. So without further ado, I'm actually going to hand over to Tom to keep the proceedings and answer a couple of those questions. And we're going to have sort of 5 to 10 minutes opening remarks from each of the panelists, then move on to the Q&A and try and get some of your thoughts. Thank you.
Thank you very much. I should state at the outset I am also alternate chair of the European Banking Authority. However, the remarks that I'm about to make this evening do not necessarily represent the views of the European Banking Authority. They do, however, represent the views of the Financial Services Authority. Now, there are a few things more controversial than bankers' bonuses. There's a widely held view that there ought to be a law. Well, there is a law, and my purpose this evening is to outline what that law says, as well as what the FSA is doing to implement that law. The relevant law is the EU Capital Requirements Directive, so-called CRD3. The remuneration aspects of this directive are implemented in the UK through the FSA's Remuneration Code. This code requires banks to implement remuneration policies and procedures that are consistent with and promote effective risk management. Concretely, the law and the code requires banks to ensure that they pay their bonuses in certain ways, and that the payment of bonus does not hamper the bank from building up the capital that it will require in order to meet its requirements over time. Neither the law nor the code regulates the amount of money that a bank may pay to any individual. It is not for the regulator or supervisor to set the level of pay for any position. That is a matter for the bank and ultimately the bank's board to decide, and the law leaves that decision to the bank and its board. The law and the code focus thus on measures to ensure that remuneration policies and procedures are consistent with effective risk management. Prior to the crisis, it was common practice for banks, particularly large investment banks, to pay bonuses as a percentage of revenues with the majority paid out in cash immediately after the declaration of year-end results. This did two things. First, it subordinated everyone, depositors, creditors, and shareholders, to the interest of employees, particularly the key employees. Second, it created an environment that fostered rather than controlled risk-taking, particularly where business line managers had a significant say in revenue recognition, valuation, and transfer pricing. In many cases, banks did not fully take into account the cost of capital or the cost of market and funding liquidity, and in the most egregious cases, banks allowed trading operations to borrow from the rest of the bank at below market rates. This inflated the trading area's revenues and bonus potential. What the law and the code aim to do is put a stop to such practices, at least for senior executives and those whose business activities have a material impact on the risk profile of the firm. Firms have changed their remuneration structures to bring them in line with the code at CRD3. The practice of big upfront cash bonuses has stopped. The practice of guaranteed bonuses has been sharply curtailed, at least in the London market. Bonuses now have to contain a very significant element of deferral. At least 40% of the bonus for a significant risk taker has to be deferred for a period of at least 3 years. In the case of senior executives, the required deferral rises to 60%. At least half of the deferred amount must be in the form of an instrument, such as common equity, that can be expected to decline in value if the firm's performance deteriorates. And all of the deferred amount must be subject to clawback or forfeiture if it becomes apparent in the light of subsequent events that the judgment regarding the person's original performance, the basis for the bonus, was seriously mistaken. Additionally, the immediate upfront payment may not be made completely in cash. At least half of the immediate upfront payment must come in the form of equity or an equity-like instrument. Finally, the law and the code impose a retention requirement on the recipient. Shares and other investment instruments received as part of a bonus must be held for a further six-month period after vesting before those instruments can be sold. Taken together, these requirements ensure that the bonus recipient is very much exposed to the ongoing performance of the institution for which she works. This limits the potential return to the recipient from taking risks that would initially show promising performance but blow up later. The FSA has also made a significant start on ensuring that the aggregate amount of bonus is consistent with banks' obligations to maintain adequate capital. Banks should be and are preparing now for an increase in capital requirements that will be implemented under so-called Basel III as implemented in the EU under Capital Requirements Directive 4. What we at the FSA have done is to review whether the proposed bonus payments, along with proposed dividends, are consistent with the bank's capital program. In this regard, it is important to emphasize that cash expenditures reduce capital, whether these are direct cash payments to employees or cash spent in the market to buy shares that are subsequently used to pay the employees' stock award. In contrast, issuing new stock allows the firm to retain funds that can be used to boost capital. In our review, we looked at banks' capital plans in the light of the proposed amount and form of bonus payments. Finally, we've begun to query how banks accrue bonus to be sure that they take all costs into account, including the cost of capital and the cost of liquidity. Where banks are not earning an adequate risk-adjusted return on capital after bonus, banks can expect a higher level of regulatory scrutiny as to whether or not they have a sustainable business model. In sum, regulation can and is bringing remuneration policies and procedures into line with effective risk management. That, and only that, is what the law asks us to do, and that is what we have done. Thank you very much.
Thank you. David, if you'd like to go next.
Thank you. Yes, I concur with a lot of what Tom has said. I'll try to be a little bit radical in my observations.
Can you sorry to speak a bit more in the mic?
Is that better? Okay. Okay?
Okay, perhaps you'll speak.
So, I'd like to make the observation that 2 years ago, Adair Turner famously observed that there was a lot of economic rent.
Could you speak up a bit, please?
That there was a lot of economic rent in the financial services industry, and that this was manifest in high compensation and excessive risk-taking. Is that better?
Yes.
Shall I start again?
Yeah.
Okay, I'll start again. So, 2 years ago, Adair Turner famously observed that there was a lot of economic rent in the financial services industry, and this was manifest in high compensation and excessive risk-taking. I don't think anyone here would take issue with that. Indeed, I don't think anybody in our industry would take issue with it. The question is why, in a supposedly competitive industry, do these rents accrue, and more importantly, why they're so high? Well, the answer to why is barriers to entry. It has to be, always will be. The answer to why so much is taxpayer subsidy, created through the implicit and actually ultimately explicit taxpayer finance credit protection. However, having correctly diagnosed the disease, legislators and regulators have spent the last 2 years treating the symptoms rather than the causes. The symptoms are excessive risk and excessive compensation. So we'll force reduction of risk by massively increasing regulatory capital requirements, and we'll reduce compensation, or at least align it in a better way with creditor and regulator interests, by imposing long-term deferral mechanisms. I think it's important actually at this point to consider what currency this deferred compensation is made in. When I say currency, I mean, should it be debt? Should it be equity? Should it be some sort of long-term incentive plan? Famously, Alan Greenspan, the then chairman of the Fed, observed that he couldn't understand why shareholders had proved to be such poor custodians of assets that they owned in the financial services industry. In other words, he couldn't understand why the system hadn't regulated itself, so to speak. Well, that, frankly, is to misunderstand the payoff to an equity investor. An equity investor owns an option against the creditors in a financial institution or in any institution. And the payoffs to equity in financial institutions are far more option-like than they are in commercial companies because of the leverage embedded in the financial institution. So when we look at the actions of shareholders throughout the noughties in banks and financial institutions, they were behaving entirely rationally. Why is that? Because if you own an option, your interest is to increase volatility, and here volatility is completely synonymous with risk. So the shareholders in banks and financial institutions were self-interested in increasing risk, contrary to Dr. Greenspan's presumption that they might control risk. Now, let's think if the shareholders long the option, who's short the option? Well, the short option position is with the creditors. But if the creditors, and they're the natural risk constraining agents in any financial institution, if the creditors have laid off their risk to governments or to taxpayers, then they don't care about controlling the risk in the financial institution. That's effectively what happened. So, we've looked at the symptoms. It would be far better if we could treat the causes rather than the symptoms of this malaise. The causes being government subsidy and barriers to entry. Unfortunately, both of these have increased dramatically as a result of the credit crisis. The public subsidy is more explicit and much more valuable than pre-crisis, and barriers to entry, many of them regulatory, have increased dramatically. So, unfortunately, we have to concede that treating the causes may be just too difficult. Universal banks are the transmission mechanisms through which public subsidy washes into investment banking. And as a result, these economic rents become concentrated in the hands of a relatively small number of people. But there's no way the universal banks are about to be dismembered, let's be clear about that. There may be a groundswell of support for Glass-Steagall 2 in both the UK and the US, but the view in continental Europe is that we've always had a universal banking system, it works for us, and the credit crisis was the fault of the Anglo-Saxons, so why should we change? Fact is, the European banking system became far more level than the US banking system, precisely because there was greater belief in government creditor protection. Going forward, it would be much better if deleverage were achieved through the removal of creditor protection, rather than imposed by regulatory diktat. The arbitrary nature of the rules and their interpretation by regulators risks further misallocation of financial resource. We were discussing earlier some of the misallocations of financial resource which followed regulatory capital rules in the run-up to the crisis, and they, frankly, were mechanisms which created, in some way, the crisis. There's a risk that the same thing happens in reverse as the system delevels, and assets are forced out of bank hands at the wrong price because the regulation forces it. So in conclusion, I think we can confidently assert that the financial system risks will continue to abate because of the actions of the regulators, which frankly are necessary, and that associated compensation levels will also decline. But the underlying mechanisms that gave rise to asymmetric payoffs, whereby profits are socialised and losses are privatised, remain in place today. Thank you.
Thank you. I suspect you probably will be able to hear me. Can you hear me? Yeah. If you can't wave at the back. I'm Martin van der Weer from The Spectator. And my aim here is to lower the tone as far as I possibly can for you, because I think that this is a really fundamental problem that we're addressing here, a clash between global market forces in the financial industry on the one side and a really quite strong and tangible and corrosive national sentiment about how much bankers are paid at the moment, which is a bad thing in our national life at the moment. So what I'm going to talk about is not, as it were, with great respect to all the interesting measures that Tom outlined there, I'm not going to talk about, as it were, tinkering around with rather sophisticated instruments and solutions here. I'm going to try and illuminate to you the fundamental problem that needs to be addressed, and how it can be addressed, that's for our Q&A session, but I think it has to be addressed by leadership, particularly from the boards and the very senior executives of banks and from institutional investors. So let me be very clear, I'm not going to argue, even as a devil's advocate, I'm not going to argue for an over-regulated, state-dominated banking system. I applaud bankers who build big, successful businesses, like my friend Bob Diamond. At least I think of him as a friend. I don't know what he thinks of me. I'm glad banks are rebuilding their capital bases through a return to profit and a return to lending and pricing risk at more prudent levels. I think it's completely pointless to discuss relativities between bankers and teachers, judges, soldiers, and so on. But I don't think it's entirely pointless to compare them with middle managers of other kinds of multinational companies or partners of global professional firms. And I think if you do that, you would generally find that the bankers are paid more than anyone who is remotely in an equivalent job. What I can say is I'm kind of appalled, because I was a banker for 15 years, by, to use Gillian Tett's phrase, the silo mentality of the financial world. The remarkable insensitivity
to what's going on in the rest of the country. So the view I'm expressing that bankers are simply paid too much isn't one that's narrowly held by the leaders of Unite and Unison and so on. It's one that is very widely held. Where I live in Yorkshire, everybody thinks the bankers are paid too much. So there is a problem in there. I was appalled at the insensitivity of the fact that base salaries, because bonuses are more difficult to pay, base salaries went up 50%. When most of the nation, one way or another, a lot of people are on part-time working, a lot of people are about to lose their jobs. Journalists, I'm afraid to say, mostly haven't had a pay rise for 3 or 4 years. And so to have an enormous rise in base salaries is an extraordinary offence, really, to public sentiment. And I think that the financial world has somehow fallen prey to a kind of collective delusion that it actually deserves to be paid at this level. Well, I put it to you, it doesn't deserve to be paid at levels which cause such widespread offence to everyone else. Let me tell you a little bit about my city experience. I'll try not to go on at great length, but I worked in the city before there was a bonus culture, and when the bonus culture came along. I started on £52 a week in 1976. That's roughly what the Spectator pays me now for writing the around about from 1984 onwards, from the first pre-Big Bang takeovers of stockbrokers and so on, remuneration became a constant topic of conversation in a way that it hadn't been before. Before, people's self-esteem was something to do with prestige, with belonging to these wonderful historic firms and so on, much less to do with the money, to be perfectly honest. But from Big Bang onwards, behaviour changed. The element of greed and aggression in people's business behaviour, a lack of collegiate trust, endless rows over profit splits between the trading floor and the corporate financiers, and so on. The business, this was at BZW, the predecessor of Barclays Capital, I should say. The business quite evidently became much harder to manage because of the remuneration issues. The shareholder interest was kind of deflected or talked out time after time with sort of verbose grand strategy in which the shareholders or anyone trying to speak on their behalf was told, well, think how magnificent this business will be in 5 years, 10 years' time. But actually the time horizon of the people saying that was 2 or 3 years, was how much money they could make before they were fired, before they got a better offer from another bank, and so on. So there was something that crept in that was fundamentally skewing the fairness of the business itself. I think it was unthinkable in those days that the bonus total could exceed the dividend total of any bank you care to name, really. But now we see, I think Barclays this year, am I right in saying that the bonuses are 3 times the dividend in the results just announced? Some other things that I learned. Out of 2,000 people in the investment bank I was working in, I think I was trying to put a fair number on this for the purpose of argument. I would guess between 25 and 50 of them were really stars. They really were money-making machines. They were the people who could drive the success of the business. The other 1,975, as it were possibly competent. If they weren't competent, they were going to get fired. If they were competent, they were basically taking a ride on the capital, the infrastructure that was provided, and the direction of the markets at the time. But they were not uniquely talented in any way at all. If you compare them to oil geologists trying to get oil out of the Arctic Circle or wherever it is, if you compare them to drug scientists and managers of their drug pipeline in a giant multinational pharmaceutical company, in what sense is banking a business that's more difficult, that deserves to be paid higher? I was at an investment seminar this afternoon where one of the speakers said there's really very little innovation in finance, there's just short memories. All the innovation in finance has been completely disastrous for the last 20 years or so, because it's all to do with creating forms of security in which the risk wasn't properly calculated and which went horribly wrong. So, even back in those days, late 80s, a degree of complexity crept in to ways of paying ourselves. I mean, I say ourselves, I was at one stage Chief Operating Officer of the Corporate Finance Division of BZW, so I was intimately involved in working out how much we could pay people in a division that was actually losing money hand over fist for the Barclays shareholders, never did make money and was eventually sold off in pieces several years later. There were phantom options. I had a few of those. They really surprised me when they turned into cash. Sometime later, actually, after I'd been fired, I think they turned into cash. There was talk of mysterious Bermuda trusts for these 25 top stars and so on. It was all becoming, I thought, deeply, deeply unhealthy. And yet, people making this money, they're not taking investment risks, they're not really risking their own capital. The only capital they're risking is the capital that their employer has generously given them over a period of time. They become extraordinarily rich, relatively young, the ones who make it up the hierarchy and can take the pressure and all that. But actually, beyond a certain point, there's this famous phrase used by, I think, an oil man called H.L. Hunt, that beyond a certain point, money is just a way of keeping the score. And that's one of the things that's so offensive to the wider public. Actually, a pretty substantial cut in bankers' pay, some sort of moratorium on large bonuses for several years would make absolutely no difference at all to the quality of life of most of these people who have already been in that game 15, 20 years and so on. So there's an element of machismo in keeping the big numbers, you know, as big as possible, which isn't to do with their quality of life. They're not going to have to take their kids out of Eton if they don't get a bonus this year. So there's, you know, what I'm trying to paint to you is the offensiveness of this, which is not created by politicians. It is egged on by the media. I will happily agree with you about that. But I think it is a direct, you know, there is a direct response from the wider public to what's going on. So that's the basic position. As to the detail of how it can be better done, I think that's, my two colleagues have already described that. Of course, there should be a long deferral. I like the idea, which I think is sort of, in what Tom said, of a malus as well as a bonus. That is to say, you have a bonus pot accruing in your name over a long period of time, and some years it actually goes down because your team or your department, your division hasn't made any money. I am not impressed by the idea of more transparency, which is part of this Project Merlin deal, that 5 or 8 of the highest paid people will be listed. I don't know whether they're going to be named by name or their job. No, they're not going to be named by name, but I can't see what point that serves at all if the levels, the quantum, is still as big as it is now. That'll simply annoy people even more. They say, look, they've got 8 people being paid £5 million each. That achieves nothing at all, really. I think that that the payment of bonuses should be as closely aligned, closely align the interests of employees and shareholders. So the simpler it is, the more it is in ordinary shares. It seems to me, in some ways, preferable that the company, the bank, has to buy shares in the market in order to dish them out as bonuses, rather than having a continuous small dilution effect that builds up to a bigger dilution over a period of time, and so on. But, you know, and I've studied these cocos and synthetic cocos. That all sounds tremendously exciting. You can imagine lots and lots of people in the city of Canary Wharf thinking, oh yes, here's another opportunity to pull the wool over the eyes of, you know, the poor tax-paying public, and pay ourselves a whole heap more by calling something a synthetic cocoa and all of that. Well, I do know how they work, and I can see that they would reflect the overall performance of the bank if they either turn to ordinary shares when things get bad, or simply evaporate out of sight, I think, if they're synthetic. But still, I suggest it's best to avoid the whiff of sophistication, the whiff of complexity every time this is discussed, and come back to the absolutely basic point. The bankers somehow, over our whole generation since the mid-80s, have achieved being paid far more than anyone else outside their sector thinks they're worth. Something somehow has to happen to edge that down in, you know, significant steps that the public can see and that really makes a difference. Would that really be damaging to this huge industry which employs 2 million people? Well, I suggest to you, because the number of people, you know, the 0.0 something percent of employees who really make a big difference can still be well remunerated. The rest, I don't think it makes that great a difference. I don't think we would lose our financial industry if there was a really brave attempt to adjust this problem. So I think it comes back to the senior management, to the board of directors, to the big institutional shareholders to show some leadership. And this is not an extreme view I'm expressing to you. I tested it not a week ago on someone, I can't name him, but he's a very, very famous business figure in this country, chairman of a very major company, has successfully led a number of companies. And I said, what do you think about that? He said, you're completely right. There is a total delusion in the financial world. There is a total lack of leadership on this issue. For 3 years, they could say, look, we've had it extraordinarily good. We made an appalling mess collectively in 2007, 2008. You boys, just hold on. You're still going to get rich by the time you're 50. But we have to have a period of genuine restraint. We have to make our contribution, make a certain amount of atonement for what's happened. And this is the way to do it. And I think it's really as simple as that. So I put it to you that this is really a simple and fundamental issue and not one of complexity and detailed, complex solutions. Thank you.
I'm now going to open the floor to some questions. I mean, I've got one that comes to my mind first of all, particularly on some of the things that both Tom and David have been saying. It seems that, and in fact Martin, to be quite honest, that the way we're structuring those kind of bonus payments, we haven't really talked a lot about how you might try and actually align a little bit more with those kind of debt holders, with those sort of bank creditors, as it were, as opposed to just say forcing it to be an equity component. I just wondered a little bit more about whether Tom, you thought that was a way that the regulation would like to go. You would like to see more of an alignment with all stakeholders within the bank rather than just per se to equity holders. And David as well, whether or not you had thoughts on that. Perhaps we just speak from the seat.
Yeah.
Was that working?
If it's working, I should be able to start.
Yeah, I should have made it clear. I mean, the point I was trying to make is that equity interests and creditor interests, and by implication taxpayer interests, taxpayers and creditors are pretty well aligned in this, are at odds. And if you pay employees in shares, you may not be aligning them as you would wish to the interests of creditors and taxpayers. They're still incented to take risk if they own equity, and the actions of shareholders in banks and financial institutions demonstrates that. So while it might be superficially interested, appealing to feel that employees and shareholders are aligned through the ownership of equity, that's not the real issue. The real issue is that employees need to be aligned with creditors.
I broadly agree with that, and we certainly reviewed Barclays contingent cash instrument in that the cash element of bonus in the Barclays payment in the deferred portion of that cash is contingent on Barclays meeting its certain capital ratios. If they don't meet the ratios, the people don't get the money. That is something we certainly look at more intensively over the coming years.
Perfect. No, sure. To the floor? Right. If I'd like you to please state your name and where you're from. And also, I keep questions and reasonably short so we can get through as many as possible. Thanks.
Hi, I'm Richard Bryant. I work for a mid-sized financial institution. I've got a question for the panel about the possible unintended consequences of this new regulation. I spend quite a lot of my time seeking to poach people from large banks, and I've found that since the new regulations are in force, that the generic managing director that might be my target as part of the creative process in the city who used to be paid a salary of, let's say, 150 to 200,000 pounds, is now paid a salary of, say, 350,000 pounds, firstly, which is way beyond my pocketbook. And secondly, a senior person has a significant amount of his deferred bonus out there from 3 to 5 years, and it's impossible for me to contemplate taking that out. So I think what you've actually done is you are entrenching in precisely the monopoly that you should be seeking to break up.
Tom, would you like to respond to that?
There is that aspect in terms of the forfeiture of deferred bonus if staff leave is essentially the barrier you're talking about. Part of it. That is a competition issue, and people have recommended that we look at that.
Next question. Yes,
Sorry, I completely agree with Richard. And the other thing with a sort of corporate management hat on, we've huge, I think somebody alluded to it earlier, we've hugely damaged the business model of the banks. Our fixed cost base has just gone up by 100% almost, it would seem. Now, that's management's responsibility, but the fact is that we all have to compete with each other. And as Richard implied, it's very difficult for marginal players to compete in that forum. But if profitability in banks diminishes, which is quite likely given the environment we're operating in, we're all going to find that our business model is severely challenged.
Yeah, of course.
Just offer you a short anecdote, really, which is when I was the chief operating officer of a division of BZW, and we got new bosses hired in from Kleinwort Benson, who looked at the salary scale and said, well, this is hopelessly uncompetitive. We must up the salaries by 50%. They did that, and of course the results then got extraordinarily bad for the next year. So I wrote, about 6 months later, I wrote a memo to them saying, don't you think we should put the salaries back down to where they were before? To which their response basically was to fire me. But I think this hike in salaries in the city is, as I said, it's just grossly offensive, and it can't be good for the businesses themselves. No sensible business would do that, really, other than through this collective delusion that I've referred to.
Can I just make a quick supplementary point, which is everybody is now talking about bankers' bonuses, and it's becoming conflated, the idea of a bank and a banker's bonus, and it's precisely the banks that you are seeking to control here who jacked the base salaries up. And now the world out there, I was thinking about bankers' bonus, by which they now mean city bonuses, which is a very different issue, and it's only the big banks that jacked salaries up by 50 to 100% over the last year.
Martin, one of the things I wanted to ask you a little bit about was, in terms of talking about leadership and how that should happen, are you against regulators being involved in sort of trying to limit pay? Do you think it should be very much from institutional investors, from kind of private sector forces?
I think that's certainly preferable. I think the regime that Tom has outlined for us is probably more detailed, more intrusive than one might expect or wish for in a really well-run industry. But yes, do people think that's entirely unworldly and altruistic? I thought it was, I'm afraid to say, I think it's a great mistake to pay the hired-in new senior executives of the banks that are, for the time being, under state control at the sort of levels they're being paid at. There was an opportunity there to start setting examples. Well, let's not name names, but they're always who we're talking about. By setting examples from the top is the only way this can embed itself, really. Otherwise, it simply goes on and on as a sort of game of trying to outwit the authorities in order to get yourself paid more.
Okay, thank you. Yes, it's just at the front.
Hi, thanks. Nigel Simon, private individual. A question which was a very stimulating talk actually from all three. I'd like to put David's point actually to Thomas, because I'm not sure it really got dealt with. David's point was actually, I think, quite an interesting one, that what you dealt with is actually the symptoms, not the causes. And if you look at the causes, as David pointed out, which I think is actually a good description, the public subsidy is even more explicit now. Moral hazard seems to have disappeared post-Lehman's as a concept. And barriers to entry, because of consolidation, are now even higher. How do you feel about dealing, which it sounds logical that you've dealt actually with the symptoms but not the causes, and what could you have done and what could you do to deal with the causes themselves?
Tom?
My talk dealt with remuneration. We are doing quite a lot with respect to other aspects. As David pointed out, we have substantially increased capital requirements that pushes the banks further away from the possibility of default and lowers the subsidy. More importantly, and in a much more difficult fashion, we are determined to put in a resolution regime that makes it possible to resolve any bank, even the largest bank, at no cost to the taxpayer and at minimal social cost. So that we will not have a subsidy and we will not be in a position of being held up by the banks.
So, Tom's right. We can't remove the taxpayer subsidy in the short term and do it in the long term as a proposition, and the resolution mechanisms are designed to achieve that. So the famous bail-in of senior creditors is designed to ensure that taxpayers are not prevailed upon to keep the system afloat. There are all sorts of problems with this, as I know to my cost, having waded through vast swathes of EU legislation around resolution mechanisms. The complexity and the lost in the weeds that's going on is frankly a recipe for either blind eyes or worse, unintended consequences. Absent anything else, we have to do this. I don't think there's any other solution. I think it's far preferable if we can convince creditors they will suffer, and thereby the system becomes self-regulating, because they won't lend into 100 times levered institutions. They'll only lend into maybe 5 or 10 times levered institutions, whatever it is. But I frankly think, unfortunately, that's a sort of slightly pie-in-the-sky hope. And the only solution beyond that is resolution mechanisms.
Thank you. Mr. Gentleman in the pink shirt.
Rob Down from the Industry Forum. I too really enjoyed the panel. So I know we've been largely talking about investment banking, but I'm going to ask sort of out of the box question and ask you whether you think, you talked about barriers of entry. I wonder if there's any possibility of radically new players coming into the market. I'm thinking of well-capitalized players like Amazon and Google, and completely taking a big section of retail and SME banking with a totally different model and a totally different cost base, and providing new competition for the retail banks, and perhaps undercutting that aspect of the universal banks business.
Sure. Who'd answer that? Tom?
There is that possibility. We welcome new entrants. PayPal is an example in terms of payment services where some of that innovation takes place. We have welcomed a new entrant, Metro Bank, and we are open for business and ready to look at applications for new banks. Happy to take them on the way out.
And do you think the regulatory levels are sufficiently low to enable that to happen? Are the barriers quite significant?
It depends. If you want to come in and have a market share of 10%, this is a pretty high hurdle. If you want to come in and open a bank, the capital requirement to do so is not that significant. We are open for business. In terms of banks headquartered in other European Economic Area countries, they are free to open branches or subsidiaries in the UK, and many have done so. And there is a provision of credit to UK institutions from foreign-owned organizations. There is a high degree of competition. It may not be as high as people would like, and there may be some people who have a rather better view of their credit rate of risk than an objective bank looking at the cash flow of their business. So it is, in terms of ability to enter, we are open for business and happy to look at applications.
Thanks. Oh yeah, Martin. Sure.
The barriers to entry, or the lack of sort of green shoots in this industry is it's a clear sign of the ill health of the financial sector, that it does seem remarkably difficult for new businesses to enter it. So yes, Metro Bank opened a branch in Holborn. A whole lot of other people were talking about opening new retail banks, but nothing much has happened. Lord Levine was supposed to be, I don't know how far he's got, but there are numerous others, but it seems extraordinarily slow to get going. What would be really healthy would be a new bunch of building societies, for example. Building society was a splendid model. It kind of destroyed itself by demutualization, but it was a very prudent and sensible model of mortgage lending. In the securities business, investment banking business, again, it would be a very healthy thing to have a widespread growth of niche, partner-owned, specialist, AIM stockbrokers, boutique corporate financiers, all of that. A barrier to that is they can all still go on collecting huge amounts of remuneration working for giant firms, actually. So I imagine the temptation to go out and set up on your own only arises basically when you get fired from the big one.
Yeah, there's a question at the back in the middle.
Hi, thanks. Duncan Brand from the Institute for Employment Studies. I don't think, partly because you spoke last, but I don't think Tom and David have really addressed Martin's points, which is that we've had a shift over the last 20 years. Well, I've been most of my career in reward consulting. When I started out, bankers were paid well, but similar to lawyers, architects, other professional people. That they've just moved massively away. And when the crisis came, it seems to me there was an opportunity to address that. Remuneration systems are not, to some extent what you've talked about, it seems as though it's economic determinism with rates, economic rents, etc. These are social choices. In Japan, differentials are much lower. There are choices that organisations make about how they reward their people. And at times of crisis, you see that particular remuneration systems are not working. The banks are all aiming at a 15% return on equity. Most of the major banks are nowhere near it. You'd need about a 40% cut in their remuneration costs to achieve that. And as Martin said, that could be achieved. There was the opportunity, it seems to me. I did work in the 1990s on insurance mis-selling. A load of salespeople paid on high commission arrangements to sell what earned them the most in pensions or whatever, not what the customer needed, major crisis, major investigations. The insurance sector, over a relatively short period of time, totally changed that compensation model, and it lowered the amounts of remuneration, and changed the way the variable pay was delivered. It seems to me all that's been done is that the remuneration model has just been shifted, as the gentleman here said, more into fixed compensation, more into long-term compensation. The fundamental amounts and the drive to sell hasn't been reduced at all. And indeed, the emphasis on long-term compensation, I think, is only going to increase the public annoyance, because it will actually increase the misfit between reported annual results and payments to the bankers, because you've got the long-term effects. And so I'm particularly interested from Tom and David to really say why they think that fundamental model that the investment bankers have had hasn't actually, in my view, shifted at all, and whether you think it will.
David, do you want to respond to that first?
Okay. Well, I think we all seem to agree, and I certainly subscribe to it, that banking is overpaid. But you can't blame people for following the rules and incentives put in front of them. And social conscience, I don't think people generally have social conscience. I think they simply follow the rules and the incentives put in front of them. So you have to question why the incentives are giving rise to such grotesque results, why the rules are giving rise to such grotesque results. And the only answer I can see is that the system is subsidised. It's subsidised by virtue of creditor protection, and it gets focused through universal banks. So universal banks collect all the deposits, but the best rent seekers aren't the bank tellers, they're the investment bankers. They're really good at rent seeking, I can tell you. So all of that money that's collected on the deposit side gets funneled into the investment banks, and you see these rather grotesque results in terms of compensation. But as a shareholder in Nomura, I have no more interest in paying employees at Nomura excessively than Tom does. I have to do it because I'm in competition with UBS, Credit Suisse, Barclays, Morgan Stanley. They're not really an issue because they don't collect deposits. But JP Morgan, all these big deposit-taking institutions are bidding high prices for the people that we employ. So we either throw in the towel and stop competing, or we try to compete with them. So, the fact is the system is flawed, and I don't have an easy solution for you, but there has to be recognition that creditors will no longer ultimately be protected.
We certainly agree on that point, and as I've indicated, we are working to make that happen, and make it happen in a manner that takes into account the complexities that David referred to in his earlier remarks. I think there's certainly a conflation when we talk bankers' bonuses. Again, David mentioned the vast majority of bankers or people who work at banks do not get the telephone book type salaries or compensation that enrages the public. We are certainly conscious of the reaction. And in terms of, is this sustainable? That is the question that people engaged in trading businesses have to effectively respond to. What we have done on the regulatory side is up the cost in terms of the capital that has to be maintained in order to have risk positions, particularly with respect to trading books. We've increased the amount of real, honest-to-God stockholders' equity that is required. We have greatly strengthened liquidity requirements. Yes, we have changed the business model. It is more costly to do a trading business. Additionally, we have to move on the resolution front. Whether this is a sustainable proposition is really open to question, and as I've indicated in my remarks, it is not sustainable to have a business that does not earn a risk-adjusted return on capital.
Thank you. Oh yeah.
I think, in answer to the gentleman at the back, part of the reason the fundamental problem is not addressed, that there is just sort of dancing around the edges of this issue, is that what I was trying to describe, which is the absolutely direct relationship, which I believe exists between excessive risk and excessive compensation, perhaps just hasn't been analysed or proved sufficiently. I know Adair Turner, I think, said at some stage, someone was quoting him just before we started, that this really was too much talk about bonuses. This was really an issue of capital adequacy. Was it? Excellent. Yeah. But as I said, from my own direct personal observation, behaviour changes as the possibility of remuneration multiplies. It's as simple as that. And I think it needs, a deep and psychological examination of that. But that's the issue that isn't
address. It's very difficult to get bankers to address it. I tried it on Bob Diamond, indeed. I've tried it on one or two senior Goldman Sachs people, but no one ever seems to want to actually discuss that. Would their employees and colleagues have behaved better, have taken fewer risks, if in fact they were not, did not have the prospect of the giant remuneration that they did have?
For that, I just want to add that the risk in banking is by no means restricted to trading activities. Most losses in banking come from the old-fashioned way, people making loans that are not repaid. When we talk about risk in banking, commercial real estate lending is an activity that produces as much or more losses than trading year in, year out. It is not exclusive, risk-taking is not exclusively in the trading book. And there are very large portions of trading activities that are conducted in a manner that is well controlled with respect to risk. So it's a big picture, it's a complex picture, but banks fail for many different reasons. But one of the primary reasons banks fail is that they lend people money that is not repaid.
But I mean, the people at Bank of Scotland, who were famously the most aggressive real estate lenders and were also taking equity slices on every real estate deal in London, you can bet your bottom dollar that they were driven by the compensation that was available to them. The fact they're not traders doesn't make a blind bit of difference. You're dealing in big numbers. It's the same psychological process.
Sorry.
So, I mean, Tom, you're absolutely right, of course. The large slugs of the losses had nothing to do with trading activities. So why is all the regulatory imposition and changes to the regulatory capital requirement focused on trading activity?
Because many trading organizations had what I call an acquire to arbitrage model. They bought the securities, they sat them on the trading book, and they never traded them. And that is essentially the story of subprime securities. They were allegedly marked to market. When people went out to sell them, it wasn't 20 basis points in the margin, it was 20 percentage points.
But this is a good example of unintended consequences. The solution to that problem is to make sure the assets are in the right place on the banking banking book, not the trading book.
We agree.
So, I mean, one of the other issues, famous issues, around securitization. I'm not sure this is the right forum, but securitization is per se a good thing because it takes risk out of the banking system. It matches buyers and sellers of credit. Right now, because there's no question securitization technology was abused, badly abused, and those abuses should be stamped on by the regulators. But as a result of that, the baby's being thrown out with the bathwater. And a large swathe of the commercial banking industry, particularly in Europe, are antagonistic to securitization, as indeed is the regulatory capital regime, and it's stifling a risk-reducing activity.
Thanks. I think let's try and move on to the next question. Thank you.
Sarah Rivers, Lexington Communications. I was interested in Martin's comment about the need for a leading figure when we're thinking about the bigger picture reputational challenge for the industry. Obviously, John Varley with Project Merlin, some would say tried to do that and tried to move the industry in a new direction. I wondered what the panel's thoughts were on the successes or otherwise of Project Merlin, but perhaps more interestingly, what lessons we can learn about how someone or a group of people might try to do that in the future and what direction they might head in.
Sure. Martin, do you want to give your journalistic comment on Project Merlin?
Yes, I should say John Varley is a very old friend of mine. One of the most straight up, gentlemanly people I've ever worked with in my life. And I think he genuinely wanted to try and make something happen there, and it appears to run into the sand. And I think where it runs into the sand quickest is in trying to do a deal about how much the banks are going to lend, because that's simply unrealistic, and everybody knows it's unrealistic. you can't force banks to lend unless you want to guarantee their lending. So that was never going to come off. Let me pass on.
Sure.
I'll have another thought.
James, would you like to add anything to that? No particular further comments on Project Merlin. The question at the back, perhaps we'll come back to that in a minute.
Hi there, Rohit Joshi from Professional Advisory Firm. And I have a question, I guess, for you, David. When you talked initially about symptoms and causes, I guess you did mention a few things about what are the symptoms. And one of the causes you wanted to tackle was essentially delinking the deposit-taking activity from the lending or, I guess, the risk-taking or the trading activity. Am I reading in between the lines, or are you supporting the initial recommendations or thoughts of the Vicar Commission here? And what is the view of the entire Vicar Commission, which does
I think the Independent Banking Commission is emotionally leading to separation. But let's be realistic about this. If you in a competition between a universal banking model and a Glass-Steagall model, there's only one winner. It's the universal bank. So that being the case, the Europeans are not going to change, so forget about that. The Americans are not going to emasculate their banks and allow them to lose to the Europeans. So what are the Brits going to do? I mean, it's not going to happen.
Perhaps you've got... Sure. I was going to say, ended list. Do you have anything further? I was going to say,
How do we get
well, I was going to say, perhaps, yeah, we're running out of time slightly, so let's go for... Do you want to begin on wrapping up?
If you wish.
Sure. We'll perhaps go the other end.
Okay. Well, I mean, I guess you got the message, what my basic point is, so let me not repeat that. But relevant to that last question and also to your question, the pressure for banking reform, for structural reform in banking, and the pressure to try and make a deal about how much the banks are going to lend to the SME sector and all of that, I suggest, would rapidly evaporate if only the banks were prepared of their own initiative to come up with a much more sensible set of numbers about the bonus pool. It's as simple as that. I don't think there's a great political will to wade in and restructure the banks. I think the Independent Banking Commission could very easily run out of track if only this remuneration issue wasn't such a hot political potato. So in the bank's own pragmatic interest, it would also play their way if they came up with a sensible set of numbers on bonuses and things, because actually it would just take the heat off them on restructuring.
Thank you. David, to your remarks?
Yeah, unfortunately the banks don't act in concert, they act individually. If they acted in concert, I think they might recognise the point you're making. Of course they do. I really don't have much more to say. It's clear to me and to everyone in this room that the system's broken. I don't have a better solution than the ones that are being proposed by the regulators. I'm fearful that it's a highly imperfect solution, and there will be, it's common currency now, unintended consequences. And you know, it's incumbent on us all, to regulators, bankers, whatever, to identify those unintended consequences and act. And that's the problem, of course. That it's hard. You know, we can see them, but can we put the genie back in the bottle before it's too late?
I'd like to end on a note that was raised earlier. Remuneration is not the issue. Resolution is the issue. In terms of working out how a bank, if it fails, can be resolved in a similar manner to a corporate bankruptcy, where investors bear losses, but the institution is able to continue as an operating business. This is essentially a corporate finance problem. It is socially impossible to have a continuous situation where banks keep the profits and society is expected to bear the losses. That is not a long-term proposition that I believe the taxpayers of this and many other countries are willing to live with. We are working to try to solve that problem. I am told that the banks are corporate finance experts. I very much welcome the banks coming together with us to solve this problem. I would submit it is in their self-interest to do so.
Well, all that remains to me is to thank our panelists, Tom, David and Martin, so much for coming and giving such an interesting insight on some of the issues surrounding remuneration. And if we could thank them in the usual manner.